Hello, everybody, and welcome to Taxes in Retirement. My name is Brad Gatto. I'm going to be your educator today, and I'm very excited to be here with all of you today. There are a lot of you in today's webinar, so that's always exciting. But I also get excited, one, just because I just love education. I love educating people on topics like this. And on top of that, it's been my experience in doing hundreds of webinars just like this, that the people that attend these webinars are doers. Let me explain to you what I mean by that. As I see it in my 16 years in the financial services industry, there are two types of people. There are drifters, and then there are doers. Drifters are people that just kind of let their life happen to them. In other words, they let their money guide their life. Doers are people that let their life guide their money. Their values guide their money decisions. And by the simple fact that you took the time to register to be on today's webinar and then actually attend today's webinar proves to me that you're a doer. And as an educator, you don't want to spend time educating people on a topic that you don't think that they're going to put into action. And so it's exciting to me to think that the majority of you, if not maybe all of you on today's webinar, are not only going to become more educated on this idea of taxes and retirement, but then be able to take that education and do something with it. And we've got a lot of resources to help you do that, which I'll get into here in just a little bit. That said, this is a journey, right? This idea of getting to retirement is a massive journey. In fact, it's probably, you spend more time, if you really stop and think about it, preparing yourself or saving money for retirement than really anything else in life. And it reminds me of mountain climbing. Now, if you were a mountain climber, and I don't know if any of you are or not on today's webinar, like I said, there are a lot of you from a lot of different locations. But if you were a mountain climber, the tallest mountain you could possibly climb is Mount Everest. And I love to bring this up because there's not a lot of people that attempt this every year. And you could probably imagine why. Not only is it quite the physical feat, but it's also very dangerous. In fact, 2019 was the height of the most people trying to climb Mount Everest. In that year, there was 1,120 people that attempted to climb this mountain. Of the 1,120 people that attempted to climb Mount Everest, 858 of them actually summited or made it to the top. Now, interesting to note, of the 858, over half of them were high altitude workers or Sherpas or whatever you want to call. They were guides. They were people helping other normal non-high altitude or Sherpas get up there. And so it's very important as you're climbing the mountain to have a guide. And so I always look at this idea of preparing for retirement or being in your working years as the mountain climb. It's not what we're going to talk about today. We're talking about taxes and retirement. And so the majority of you probably are either really close to summiting this mountain of saving for retirement and maybe not quite yet retired, but a lot of you probably already are, not only have summited, but are on your way back down. So we're going to talk about the descent, not mountain climbing today. We're going to talk about mountain descending. So in 2019, 858 people made it to the top. Like I said, over half of them were guides. On the way down, unfortunately, 8 of them passed away. The reason I bring that up is because the descent a lot of times can be even more treacherous than the climb. And I think that's especially true when it comes to our topic today, which is taxes as it relates to your retirement. I tell people all the time, if you think taxes are confusing in your working years, wait until you get to your retirement and you have to figure out not just only what you owe the IRS, that's the simple part, but more importantly, how do you minimize the impact the IRS can have on your life? It's one thing to pay your fair share of taxes. It's a whole nother thing to tip the IRS year after year after year. And so, like I said, I'm excited to be one of these guides, these high altitude workers helping guide you back down the mountain and at least help you get started with the education that you're going to receive today. So with that said, here is our agenda. I'm going to give you a little bit of an introduction into who I am and why I'm your educator for today. We're going to talk about the problem, the major problem as I see it as it relates to retirees or pre-retirees as it relates to taxes. Then we're going to dive into what I call Taxes 101. This is just kind of the baseline. Here's how taxes work. Make sure we all understand the 1040. Now, I realize this may be below the belt for some of you. Some of you maybe have been filing your own taxes for years. And so you understand the basics of a 1040 and how that works. If that's you, stick with us because in Taxes 201, we're going to get to these additional complexities for retirees. And most importantly, make sure you stick around to the end because the last thing we're going to go through is what I call the immediate impact. And this is where we're going to take all the education you get in taxes 101 and 201 and begin the process at least of teaching you what to do with it and how to apply some of that education to save yourself or your household some money on taxes. So here we go. Introduction. Like I said at the beginning, my name is Brad Gatto. I live in the Twin Cities area of Minneapolis and St. Paul in Minnesota. I was born and raised in the state of Iowa, but I've been up here for over 20 years. And I've been in the financial services industry for 15, 16, I think 17 years out now, actually. It's 2023. I own a firm called Fiat Wealth Management. We are a fiduciary-based wealth management firm in the Twin Cities area, although we work with clients all over the country. I've got clients in Alaska that we work with, clients in Florida, and pretty much everywhere in between. And we really specialize in this area of distribution planning. And so we specialize by helping families down the mountain. If you want to learn more about who we are and why we do the education on topics like this for complimentary webinars like you're on today, you can find a lot more information about who we are at our website. That's fiatwm.com. Also, should be noted that on the right-hand side of your screen, there is a Q&A box, okay? Everybody take your eyes and peel them off to the right-hand side of the screen. It says Q&A. If you tap on that tab there, you're going to have the ability to talk to a live person throughout today's workshop. And so we're excited to have that resource for you because inevitably you're going to have questions, you're going to have comments, maybe even concerns, whatever it may be. And we want to make sure that we get those answered for you in real time if possible. Obviously, because I'm delivering the workshop, I can't do that. And so I've got a colleague of mine, Scott. Scott, can you just pop your camera on for just 1 second for us? Here he is. Here he comes. I've got Scott Airy in the webinar with us today. Scott, why don't you say hi to everybody?
Hey, good morning, everybody. Thanks for having me here. Welcome to today's workshop. I'm excited to be a part of it all with you. As Brad said, I'm here to help you guys. Any questions that you have, please throw my way via the chat box. Keep me busy. It's always more fun and more interesting when you guys are involved in asking questions. And you'll hear from me on the back end of today's workshop just to follow up, make sure you got what you were looking for out of the experience. So pleasure to meet you all. Look forward to chatting soon.
All right, so Scott's going to be behind the scenes in that Q&A box for you the entire time. So thanks, Scott, for joining us today to make sure that everybody on the webinar has that resource. We're not done with resources, though, because you thought you were just getting 60 minutes of education today, but we're going to give you a lot more than that should you want to tap into it. So this is all optional for you. We just want to make sure that you get as much education as you can on this topic beyond just today. And so for attending today's workshop, you have the ability, should you want to tap into all the additional resources. We do inner circle workshops. We have a podcast. We do blogs. All of this stuff can be found at our website, fiatwm.com. We are really big on education here at Fiat. And frankly, we would love it if you would join us from the comfort of your own home in any of these different mediums in which we educate not only the families that we work with, but a bunch of people just like you across the country. So feel free as an additional resource to today's workshop to tap into any of that. And then last but not least, today's workshop is to kind of give you that base education to kind of get you started on this area of taxes in retirement. We've got Scott in the Q&A box for you and some additional resources after the fact. On top of that, we're going to talk a lot about what it looks like to kind of get moving down the mountain as it relates to taxes. And one of the hardest things to do with any journey is just get started. And so in order to help you get started and take some of the concepts and education that you're going to get today and apply it to your own situation, we do offer everybody a complimentary tax clarity visit. This will make a lot more sense to you by the end of today's workshop. But in the bottom left-hand side of your screen, a little box should have just popped up. It says to schedule now. That's for this complimentary tax clarity visit. This is just your opportunity to work with a highly trained fiduciary advisor in this area of distribution planning, like Scott, and begin the process of applying some of these principles to your life. So everybody, just so that you know what I'm talking about, on the bottom left-hand side of the screen where it says click here to schedule now, just click that button really quick. Once you click that button, all you're going to see is a calendar. That calendar is going to pop up and give you all the times we've set aside for all of you over the next couple of weeks to take advantage of this, ask additional questions, spend more time, and begin taking some of this education and moving it forward. All right. Oh, last but not least, another free resource. If you do schedule that tax clarity visit, the other resource that we have for you, I actually have a copy right here. Let me just grab it. 1 second. It's just a free copy of my book. I wrote a book last year called Spending Money and Having Fun, Your Practical Guide to a Fearless Retirement. I fancy this as your map down the mountain. You've already ascended the mountain. Now it's trying to figure out how to get back down the other side. And so this book, yes, it has a chapter on taxes, but it has chapters on a bunch of other topics as it relates to this phase of life, this retirement phase of life. And so another free resource for you should you want to take advantage of that. All right, that's a lot of free stuff, a lot of opportunity for all of you for attending today's webinar. Let's dive in to our agenda for today. As we're diving in, I'm going to start us off with a fun little video. I'm going to play the video. While I'm playing the video, if you would do me a favor, in the right-hand side of the screen, just so that I know you're all here, because you can all see me and you can all hear me, but I cannot see you and I cannot hear you. I just know that you're in the webinar. I can see your names. On the right-hand side of the screen in the Q&A tab, answer 2 questions for me while I play this video. Question number 1, are you retired or are you not yet retired? If you want to provide more color than that, I would appreciate it, because then, again, Scott and I know who we're talking to today. And so are you retired or not yet retired? If you want to say, hey, my name is Bob, I'm retired. I've been retired for 5 years. I was a school teacher. Or my name is Jane. I'm not yet retired, still working as an engineer at such and such a company. That would be great. Question number 2, what brought you here today? What questions do you have? What concerns do you have? What were you hoping to get out of today's webinar? If you could answer those 2 questions while I play this quick video, that would be great.
Every decision I've ever made in my entire life has been wrong. Every decision I've ever made in my entire life has been wrong. My life is the complete opposite of everything I want it to be. Every instinct I have in every aspect of life, be it something to wear, something to eat, it's all been wrong. Everyone.
Tuna on toast, coleslaw, cup of coffee.
Yeah. No, wait a minute. I always have tuna on toast. Nothing's ever worked out for me with tuna on toast. I want the complete opposite of tuna on toast. Chicken salad on rye. Untoasted, with a side of potato salad and a cup of tea.
Well, there's no telling what can happen from this.
You know, chicken salad's not the opposite of tuna. Salmon's the opposite of tuna, because salmon swim against the current, and the tuna swim with it.
Good for the tuna.
George, you know that woman just looked at you.
So what? What am I supposed to do?
Go talk to her.
Elaine, bald men with no jobs and no money who live with their parents don't approach strange women.
Well, here's your chance to try the opposite. Instead of tuna salad and being intimidated by women, chicken salad and going right up to them.
Yeah, I should do the opposite. I should.
If every instinct you have is wrong, then the opposite would have to be right.
Yes. I will do the opposite. I used to sit here and do nothing and regret it for the rest of the day. So now I will do the opposite, and I will do something. Excuse me, I couldn't help but notice that you were looking in my direction.
Oh, yes, I was. You just ordered the same exact lunch as me.
My name is George. I'm unemployed and I live with my parents.
I'm Victoria. Hi.
Hopefully you got a good laugh out of that. It's a wonderful video to play while you're answering the questions. A ton of you jumped into the Q&A box. I greatly appreciate that. It gives us a ton of color. If you have not yet answered those questions, I'd ask that you go to that Q&A box and do that for us. We would appreciate it. But George makes a very important point there. If what you're doing is not working, you should probably try the opposite. I play that because one of the number one pieces of feedback I get from people that attend this webinar is, Brad, it seems like you're telling me to do the opposite of everything I've been told to do as it relates to taxes my entire life. And at the end of the day, you just need to remember something. You're not mountain climbers anymore. You're mountain descenders. And if you've not yet summited, per the Q&A box, some of you are not yet retired, but you're close. You need to think of retirement differently as it relates to taxes. And so that sets the stage for us very, very well. So here's a little bit of the problem before we get into taxes 101, like we talked about in the agenda. They've been taxing you and I directly through ordinary income taxes for a little over 100 years now. 1913 was the first year they taxed you and I directly. The chart you see on the screen is the top marginal tax rate by year from 1913 through today. And what you'll notice is it's changed a lot. In the very first year of taxes, the top tax rate was 7%. Then it spiked. The highest it ever got was after World War II at 91% was our top tax rate. And it stayed that, as you can see on that chart, from the mid 1940s all the way through the early 1960s. Essentially, the majority of you on today's webinar are probably baby boomers. Baby boomers in 1946 to 1964. Almost that entire time that the baby boomers were being born, the top marginal rate was 91%. Interesting to note that all of you who are baby boomers born between 46 and 64 started getting jobs in the 60s and 70s and started earning money. It was probably sometime in the 70s that you started saving money. And you probably started saving money into these brand new vehicles that had just been invented, the IRA, the traditional IRA, and the 401k. This was the beginning of time when the onus was no longer just on your employer to save money for you through the form of a pension, but they started switching the responsibility of the onus to you as the employee to start saving your own money in an IRA and a 401k. So make no mistake that if you are a baby boomer, you are a trailblazer. You are the first generation to retire in this new modern definition of not only am I going to not work for possibly decades of my life, but on top of that, the money that I have to live on is not primarily anymore these days pension money, but it's money that I've saved. Now, some of you on today's webinar maybe have a combination. You've got some pension money and some of your own saved money. But at the end of the day, less and less people have pensions today. And we all got sold this idea that if we put all this money away in IRAs and 401ks, we should do that and defer that tax bill. Why should we defer that tax bill? Because our taxes are going to be lower in retirement than they were when we were originally putting that money away in the first place. Well, lo and behold, here we sit in 2023, and I've talked to thousands of your peers, literally thousands of your peers, and this is the average makeup of the money that they've saved. About 80% of it is in that green. That's the pre-tax IRA 401k bucket. About 15% sits in the blue there. That's the after-tax non-retirement account bucket, like a brokerage account, and then a little bit in this tax-free scenario. Of course, the problem here is the majority of the money you've saved has yet to be taxed. And now, not only when you get to retirement, you have to figure out what's affordable. How much of my money can I spend each and every month, year, 5 years, so on and so forth, to make sure that I don't run out and worried about things like sequence of returns risk or worried about things like longevity risk or whatever it may be. But on top of that, every time you pull a dollar out of an IRA or 401k, there's a tax impact to that. And that's what we're going to talk about today. Diving in, we've got taxes 101. How do they work? Let's just run through the 1040 and figure out how a 1040 works so that we're all on the same page. A 1040 really is just you telling the IRS what you did throughout the year, how much income came in the door, and what write-offs you have, so that you can figure out what your tax bill looks like. So the first thing you have to do when you go to file your taxes is you have to tell the IRS all the different types of income that came in the door. And then they're going to show you what tax brackets you fall in. In today's example, we're going to use a married couple. Okay. Throughout today's workshop, we're actually going to use a married couple. So on the right-hand side of your screen, next to where the Q&A is at, most of you found the Q&A. So again, thank you for chatting with Scott in the Q&A box. And don't forget to use him as a resource for questions. But next to that, there's a handouts tab. Now, there's a couple pieces in there on more information on who we are at Fiat and who I am personally. If you want that information, great, it's there for you. There's also a tax planning chart. And so if you are a single filer, the numbers are going to be different for you than a married couple. The concepts remain exactly the same. Okay. So if you want to look at your own numbers as a single filer, feel free to click on the PDF in the handouts tab that will get you your numbers in the tax planning chart. The last thing I want to point out in the handouts tab is it's named TIR Workbook. Now, this is a guided note-taking page. So even if you don't print it out, It is going to be helpful for you to have, but if you want to print it out now, feel free. If you're taking notes at home, it's a guided note page for you. So going back to our married filing joint example here. If as you see here, the first tax bracket is 10%. The last tax bracket is 37%. I call this the 7-bucket system. Now, the reason I call it the 7-bucket system is because there are 7 tax brackets. Again, the first one being 10%. And so if you're a married couple filing a joint return, and as a married couple, you have $100,000 of income that comes in the door in 2023. If you just kind of scroll with your eyes there, you'll notice that the $100,000 mark falls in the middle of the 22% tax bracket. So your marginal rate as a married couple with $100,000 of income would be 22%. But it's important to note that does not mean you pay 22% on every dollar of income that came in the door. The way this works is that the first $22,000 that came in, you pay 10%. Everybody starts in the 10% bucket. Okay. At $22,001, you're going to move into the 12% bucket. That fills up at $89,450. At $89,451, you're going to move into the 22% bucket and pay that until you get to that $100,000 of income. So everybody starts at the 10% bucket. Once the bucket's full, you move on, and so on and so on and so on. The visual I get in my head is of that bird fountain in the backyard, right? Where the top water reservoir fills up, and once it's full, it spills into the next reservoir, and it spills into the next one, so on and so forth. That's kind of the way taxes work. Also important to note before I move on here is that these tax brackets that you see here, 10, 12, 22, 24, 32, so on and so forth, those are set to change. So if you are unfamiliar, we are living in this time called the Tax Cuts and Jobs Act. Now, this is really important. So if you're taking notes at home, I would write this down. The Tax Cuts and Jobs Act was passed in 2017, went live in 2018. What it did, net effect, was it changed a lot. About 23 different provisions changed in the tax code for you and I. Net, the vast majority of Americans saw a reduction in their tax bill because of the Tax Cuts and Jobs Act. What does that mean? Layman's terms, your taxes are cheaper today than they were in 2017. In other words, they're on sale. But interesting to note that sale is not permanent. The Tax Cuts and Jobs Act sunsets or goes away at the end of 2025. So in 2026, we're going to go back to the law from 2017, which means the vast majority of you on today's webinar are going to see an increase in the effective tax rates that you pay. The reason I bring that up right now is, one, it's just important for all of you to know, because when it comes to tax planning and you're trying to minimize the overall impact the IRS can have on your life, of course you want to pay your taxes when they're cheap. I'm telling you, for the vast majority of you on today's webinar, they're cheaper today than they're going to be in a couple of years. This slide's a great example. The 10% bracket is going to be 10% when the Tax Cuts and Jobs Act expires, or TCJA for short, if you hear me say that. 12% is going to change back to 15. 22 is going to change back to 25. 24 is going to change back to 28, so on and so forth. And so one of the 23 provisions was a reduction in some of these ordinary income brackets that you see on the screen. So when it comes to this 7-bucket system, what's important to note is, number one, like I said before, even if you're at the 22% marginal rate, married couple, $100,000 of income, does not mean you pay 22% on every dollar. And also important to note that a lot of these brackets are going to be changing come 2026. Now, everything that comes in the door from an income perspective, it could be pension income, it could be earned income through a part-time job that you have, it could be IRA distributions, you name it, is taxed at these rates. There are 2 exceptions to that, and I'm going to get to that in just a second. If you want to visualize the 7-bucket system, it looks like this. It looks like a set of stairs, doesn't it? And so as the income comes in the door across the bottom of our chart here, you start to pay taxes. You start at 10, and then after that bucket's full, you step up to the next stair, 12, 22, you guys get the point. I've highlighted a couple of the numbers here simply because this set of stairs is not even, right? It doesn't look like the set of stairs coming into your house where every step is the exact same size. These are all very different sized stairs. And there's a couple of steps here you got to really watch out for because they're doozies. The difference between 12 and 22% from $1 to the next, your rate almost doubles. And then later in the code, we have another significant jump between 24 and 32%. But when you start to visualize it that way, you'll notice some of these jumps aren't that significant. 10 to 12, 22 to 24, 35 to 37. Yes, you do end up paying a little bit more, but it's not significantly more from $1 to the next. But there are a couple of stairs that are doozies that we really have to watch out for. Now, I just defined for you, like I said before, your marginal tax rate, which is the tax bracket your last dollar of income fell into. We gave the married couple $100,000 of income, 22% marginal rate example. I also told you there are two types of income that can come in the door that you do not pay 7-bucket system rates on or ordinary income taxes. There are two things, capital gains and qualified dividends, that you get a completely different tax treatment on. They're taxed at what I call the 3-bucket system because there is only 3 tax brackets here. They're 0, 15, and 20%. Now, important to note if you're taking notes at home, that these rates, capital gains rates, are preferred or preferential rates. In other words, they're cheaper. If you could get all of your income to be taxed at these rates, you would want to have that happen. But there's only 2 things that we get this preferred or preferential rate on. Let me go back. Capital gains and qualified dividends. Let me define those for you very quickly. So if you have non-retirement account money, it's money that was in your checking account at some point and you chose to invest it because you didn't like the 0.02% that your bank was paying you. And so you chose to invest it and you put it in a brokerage account and you bought Apple stock. And that Apple stock goes up over time. You have to pay taxes on your gains. Those are called capital gains. Now, depending on how long you held Apple stock is what's going to determine what your tax bill is going to be. If you held Apple stock for at least a year, they're going to give you these preferred or preferential rates. Okay. If you sold Apple stock a month after you bought it and you had gains, that's a short-term capital gain. They're going to kick you back to the 7-bucket rates and make you pay full retail rates on the growth of that stock. So long-term capital gains, as defined by non-retirement account investments held for at least a year, those gains, you get the preferred or preferential rates. Short-term gains, they're going to make you pay full retail rates. And then also qualified dividends. If you have stocks that kick off a dividend, Apple would be another example because they do have a dividend now, that if you got a stock from Apple, that would be a qualified dividend. What makes that qualified is it's a United States domiciled company. Okay, so if your dividend is coming from a U.S. company, it's going to be a qualified dividend. Now, there's some exceptions to that we're not going to get into in today's educational webinar because that's like taxes 401. But on the whole, United States domiciled companies are going to kick off these qualified dividends, which means you're going to get these preferred or preferential rates that we keep talking about. Now, if it's a non-qualified dividend, either it's a non-United States company or it doesn't meet the holding periods of what I kind of alluded to with taxes 401, they're going to kick you back to the 7-bucket system just like they do on short-term capital gains. Okay. So everything gets taxed at full retail rates except long-term gains and qualified dividends. You get these preferred or preferential rates. If you want to visualize that on a set of stairs, it's obviously a much simpler set of stairs. For a period of time, the first bucket is 0. That's a great bucket to live in. Then it's 15% for a very long time until you're over $500,000 of income as a married couple. And then it does bump up to 20%. All right. So now that all the income's come in the door and you've added all that to your 1040, whether it was 7-bucket income or 3-bucket income. Now, a lot of people at this point ask, well, Brad, what about this particular type of income? What about this particular type of income? If it's anything other than long-term capital gains or qualified dividends, you pay 7-bucket rates or full retail ordinary income tax rates. Okay. The next thing you do on your 1040 is you start subtracting things. You get to subtract out your deductions and your exemptions and your credits. Now, it's important to note that exemptions, which have been around for a long time, were done away with during the Tax Cuts and Jobs Act. So that was a negative because you used to get to exempt $4,050 of income for everybody in your household. Okay. What they did to replace it, though, was they made your standard deduction significantly larger. In 2017, the year before the Tax Cuts and Jobs Act was put into place, the standard deduction for a married couple was $12,000. Today, as you can see on the screen, it's $27,700. If you do not know what a deduction is, it is this simple. the first $27,700 as a married couple, or as you can see there, $13,850 for a single filer, you do not have to pay taxes on. You get to deduct that income and not pay the associated tax bill. Okay. So obviously, the more deductions you can have, the better, because you're just hiding, in essence, more and more income from having to be taxed. And so having a $27,700 standard deduction is quite significant. That's a lot of money. You get an additional deduction if you're over the age of 65. If you're single, you get an additional $1,700. If you're married, it's an additional $1,300 per spouse that's over the age of 65. So if you're both over the age of 65, it's an additional $2,600 you get to deduct. Now, some of you maybe itemize your deductions, or you've at least heard of itemizing your deductions. There are certain things we all get to write off on our taxes. It could be healthcare expenses. It could be property taxes. It could be mortgage interest. It could be taxes you pay to the state in which you live. It could be gifts to charity. There's a litany of things you can write off on your taxes. But if you get to the end of the year and you have your full list of all your write-offs, and that list doesn't add up to at least $27,700 if you're married, well, then you're going to take the standard deduction instead. Because why? If your own itemized deductions only add up to $25,000, well, would you rather hide $25,000 of income or $27,700? It's a no-brainer, right? Now, if your itemized deductions go above the standard deduction, you would itemize instead. And so it's important to always keep track of what you can write off. But note, a lot of you on today's webinar are probably taking that standard deduction, okay, and getting to write off the first $27,700 or $13,850. And that additional deduction, we don't want to forget about if you're over the age of 65. And then there's credits. Credits are different, okay? Deductions hide the income, so you don't have to pay the tax bill on that dollar of income. So in other words, if you had a 12% tax bill on a dollar of income, that you just saved 12 cents. Whereas a credit, if you get a dollar credit, it saves you $1 off your tax bill. Credits are better than deductions if you can get them. They're like little Easter eggs hiding all over in the tax code, and you just have to find them and see if you qualify for them. Let me give you an example. The first one on our list here, healthcare tax credit. Now, if you're if you're not yet age 65 and you're retired, okay, you're lucky enough that you got to retire before the age of 65. The good news is you got to do that. The bad news is you're not old enough for Medicare yet. And you're retired, so you lost your employer-sponsored health plan. So now you have to go out to the private markets to get health insurance. Well, obviously, that's pretty expensive. Well, did you know you could get a tax credit to help you pay for your health insurance? And actually, you could get tax credits to completely subsidize it. In other words, you could get your health insurance premiums essentially free through tax credits. Well, how do you know if you qualify for that healthcare tax credit, or that premium tax credit, as they like to call it? You have to know what your modified adjusted gross income is. Now, your modified adjusted gross income is affected by pretty much everything that hits your 1040. And it's important to always know and be cognizant of where that's going to fall to see if you have access to any of the credits that exist in the tax code. Like I said before, they tend to be kind of like Easter eggs all over written in the code, and you just got to know where to find them. So if you want to visualize what I just got done talking about, deductions take the entire set of stairs that we just got done visualizing, and they just push it to the right. Okay. You actually don't hit the 10% bracket until you get all the way through the standard deduction. So a married couple, $27,700. It isn't until $27,701 of income, if you take the standard deduction, that you start paying 10%. And then you fill that bucket up. And then you fill up the 12% bucket, so on and so forth. But again, deductions just take the entire set of stairs and then just kind of shove it to the right. Checkpoint. We're done with taxes 101. But we're going to have checkpoints all along the way here. And these are the questions you should be asking yourself. At the end of the day, if you want to maximize the education today, or another way to look at that would be minimize your taxes and how much the IRS is taking from you, make sure that you have all of these checkpoints done. And if we go through this and you have not gone through all of these checkpoints on your own, or you don't have a high altitude worker or an advisor that's helping you do these things, we can at least help you get started on some of these things, okay? So checkpoint, have you taken advantage of the Tax Cuts and Jobs Act? In other words, are your taxes on sale? Have you ever asked that question? Has anybody ever calculated that for you? Because like I said at the beginning, the majority of you saw a reduction in your tax bill because of the Tax Cuts and Jobs Act. Not everybody, but the majority of you did. And that tax sale is not permanent. And so you want to take advantage of it while we have it. So the first question you need to ask yourself is, wait, are my taxes on sale? If you don't know the answer to that question, we can help you find out. Okay. Second, have you taken advantage of the different tax buckets? In other words, do you know what falls in the 7 and 3 buckets, and are you taking advantage of them? Are you getting the most out of your capital gains, the most out of your qualified dividends, things like that, or just your regular dividends? And then have you maximized your deductions and credits? In other words, are you making sure you're tracking all of your itemized deductions? Are you being creative with what you're writing off? Or do you have gifting strategies to nonprofits to maximize the write-offs for that kind of stuff? Are we taking advantage of that? All right. Great checkpoint. All these checkpoints are in those guided notes that are on that PDF and that handout for you as well. Now, if you have any questions on Taxes 101, make sure you jump into that Q&A. Scott is sitting there waiting for your questions. We're going to move on to Taxes 201. Additional complexity for retirees. We're going to go through 4 key areas here: RMDs, capital gains, Social Security, and Medicare. What do you need to know as it relates to taxes in these 4 key areas? So starting with RMDs, or required minimum distributions. If you are unfamiliar, all of your qualified money, which is a fancy way to say your pre-tax money, okay? All of your pre-tax retirement accounts, 401ks, IRAs, 457 plans, 403b plans, things like this, the IRS, while you were saving your money and you were climbing the mountain, they said, sure, absolutely, you can put it away on a pre-tax basis. We'll let you defer that tax bill to a later date. Caveat, you cannot spend it right now. They said until you're 59 and a half years old, if you pull any money out of your 401k or your IRA or otherwise, we're going to penalize you. And the penalty is 10%. So you have to pay the associated tax bill plus a 10% penalty to be able to pull that money out. Then at your magical age of 59 and a half, they allow you to pull it out without any penalty. Then 13 and a half years later, they come back to you and they have a completely different tune. They say, okay, now that you're age 73, that's bolded there because that just changed here recently. Once you reach this magical age of 73, now you have to pull the money out of your IRAs and 401ks, or we're going to penalize you. It's called a required minimum distribution. You have a required minimum amount of your pre-tax accounts that you have to pull out every year for the rest of your life once you reach the age of 73. Now, what's on the screen is the calculation you have to use to figure out what your requirement is. So now you're going to force me to pull IRA money out, even though I may not need it. Yes, we are. How much do I have to pull? Well, how much money do you have? And then what is your age? And then what is your distribution period associated based on this uniform lifetime table that you see on the screen? And so the example that we have for you today is a 73-year-old, first year of RMDs. And so I highlighted that box. You can see there at 73, the distribution period is 26.5. So what you do is you go back and you look at your December 31st balance of last year of all your pre-tax accounts. You add it all up. If that balance happened to be exactly $1 million and you're 73 years old, so you have your required minimum distribution due this year, you take $1 million, divide it by that distribution period of 26.5, and your required minimum distribution is going to be $37,736. Okay. Couple things to pay attention to here and why this is so important. One, if that $37,736 is income you don't need, doesn't matter. You have to pull it anyway, and it's going to hit your 1040, which means it's going to affect your adjusted gross income, and it's going to affect everything else on your taxes. So really important to understand that this is coming. Now, some of you may already be of RMD age and thinking, well, gosh, Brad, I'm too late. I'm already 73. I can't do anything about this. That's not true either. And if you have questions on how to minimize the future impact of RMDs after today's workshop, make sure you get with Scott and ask that question because it's vitally important. Also important to note here, if I go back to my chart, you'll notice that the distribution period each year, as you get older, the distribution period goes down. Well, if I divide $1 million by a smaller number than 26.5, I'm going to get a bigger result. In other words, the percentage you have to pull out every year goes up. And so if your account balance maintains because of market growth, or maybe even goes up because of market growth, just know that not only will you have these RMDs, but it's possible that they get bigger every year as you get older, which means they're going to have a more significant impact on your 1040 or on your taxes. Now, bonus item, you can see there on the left-hand side, QCDs. QCD stands for Qualified Charitable Distribution. What in the world is that? Now, if you're one of those people that is charitably inclined, whether that's to the Red Cross, your church, or otherwise, and you're giving money to charity, it's very possible, I see it all the time, that your gifts to charity don't actually result in a tax write-off for you. That's because you're taking the standard deduction, because you're not gifting more than the standard deduction when you look at your itemized write-offs. And so those gifts to charity may not actually mean anything from a tax perspective. Now, if you're giving to charities, we all know it's a matter of the heart. And I don't want to argue that. But of course, if you feel led or called to do that, it would also be nice to get the tax break. Once you get to RMD age, you can actually take your RMD directly from your IRA, give the money direct from the IRA straight to the charity. You can't touch the money. Let's go straight there. It will satisfy the RMD, and you still get to use the standard deduction. It's almost like double dipping, okay? And also interesting to know that the QC, they've changed the RMD age a couple times in the last couple of years. It used to be 70 and a half, then they moved it to age 72. Now it's 73. But the QCD portion is hard-coded into the tax code, so they didn't change it. So you can actually begin QCDs at age 70 and a half, even though the RMD doesn't start till age 73 now. So if some of that you got lost there, but you are charitably inclined and you're approaching RMD age, you're trying to develop an RMD plan, it's important to ask the questions to make sure you understand, because it can have a very significant impact on your taxes and the savings associated by doing this correctly. All right, next one is capital gains. So putting the 401ks and IRAs aside for just a second and looking at that blue piece of the pie we talked about when we talked about the problem up front, these after-tax accounts. It's just very important to understand how you're invested in these after-tax accounts, because unlike your IRA or 401k, where for years you've been able to put money in there, you can rebalance the account, trade all you want, and there is no tax impact, because as long as it stays in the IRA or the 401k, you don't have to pay taxes until you choose to pull the money out. And so it's all kind of sitting confined inside of that IRA or 401k. Whereas in your after-tax accounts, that's not true. The buying and selling going on is taxable as it goes on. Now, the most popular investment, and it has been for years and years and years, is mutual funds. Mutual funds are just a basket of stocks or a basket of bonds or a basket of commodities or whatever it is that comprises your mutual fund. But it's just a way for us to get easy diversification without having to go out and buy the individual stocks on our own, or frankly, just be smart enough to do that and know which stocks to pick or which bonds to pick. The problem with them is they can cause what we call pass-through or phantom gains for you on your taxes. Now, what that means is this. If you're in a mutual fund and you buy ABC Mutual Fund, you're not the only person in that fund, right? You're in there with 1 million of your best friends that you don't know. And there's money flowing into that fund every single day. There's money flowing out of that fund every single day. And because of that, the mutual fund manager has to deploy the cash when it comes in, buy, and it has to raise cash when people want to pull money out or sell. And so there's buy-sell transactions going on inside of these mutual funds all the time. And those buy-sell transactions can cause gains for you that you may or may not want. And not only that, they can cause phantom gains. Example, if you bought into a mutual fund just 1 year ago, and one of the stocks inside there is this Apple stock I keep talking about, right? And so you did get to participate in the growth or losses of Apple stock over the last year. But that fund actually bought that stock back in 1987. It's been in that stock for a long time and has a lot of gain because Apple has grown just a little bit since 1987. If they choose for whatever reason to sell out of that position this year, you, as one of the mutual fund owners, has to pay your fair share of taxes all the way back to 1987, even though you just got into the fund a year ago. Does that seem fair? Of course, it doesn't seem fair, but that is the way that it works. So it's vitally important from a tax planning perspective that with your after-tax accounts, you know exactly what you're invested in and how that's going to impact your taxes at the end of the year. We see it all the time here at Fiat where families come in, they've got all these capital gains, or maybe even sometimes capital losses, or their dividends aren't what they thought they should be on their taxes at the end of the year, and they don't really understand why it's happening or what is happening. And a lot of times it has to do with the allocation of your monies and how you're invested in these after-tax accounts. So something to be very aware of. And not only that, but if you start thinking about these two things in tandem now, we've got RMDs and capital gains. So an RMD can come into your life whether you want it to or not, right? You're 73, they force you to take all this money out. The second you pull $1 out of an IRA or 401k, that's income. It's the 7-bucket system. So now all of a sudden your AGI went up, your adjusted gross income went up because you had an RMD, even though you're not going to spend the income. And then this can happen. You can get capital gains kicked off at the end of the year. Even though you made no trades, you hold all the same investment positions. But all of a sudden, you've got these capital gains because you own something like a mutual fund, and it's kicking them off for you whether you want it to or not. And that can add to your income. That can start to create problems. In fact, all of that can start to affect how you're taxed on your Social Security, which is our next topic. Social Security has its own set of rules. It's taxed based on what's called a provisional income calculation. Okay? Provisional income is comprised of 4 things. The first one, and remember this, it trips a lot of people up, is half of your Social Security benefit. The second one is all your 7-bucket money, all your 3-bucket money, and any non-taxable interest that you have. They take those 4 things, they add them up, okay? Then what they do is they apply that calculation to the thresholds you see on the screen. Single filer, first threshold, 25, second threshold, 34,000. Married couple, 32 and 44 are the thresholds. Here's how this works. Any income below, as a married couple, below 32, not taxed. Any income between over 32, half of the benefit gets taxed, half of it does not. Any income over 44, 85% of it's going to get taxed at whatever your tax rates are. The other 15% is not. A couple takeaways there. Number one, it is possible to get your Social Security federally tax-free if your provisional income is low enough. Takeaway number 2, everybody, no matter how high your income is or your provisional income is, gets at least 15% of their Social Security tax-free, because as you can see there, even at the top threshold, only 85% of your benefit is going to be taxed at whatever your tax rates are. Let me give you an example. Client A up top, first example, needs $60,000 of income. They have $20,000 coming from Social Security, so they take $40,000 from their IRA to get them to the $60,000 that they need. That makes their provisional income $50,000, because remember, only half the Social Security counts. Half of 20 is 10, plus 40 is 50. You take that 50, you apply it to the thresholds we just got done discussing. Net result, 55% of their benefit is going to be taxed. 45% is going to come in tax-free on a federal level. Your neighbor comes and talks to you over the fence and says, hey, I'm living on $60,000 a year of income too, but I pay a different amount of taxes than you. How can this be? Well, what you didn't dig into is that your neighbor actually has $40,000 of Social Security coming in the door, as you can see there in my second example at the bottom of the screen. So they're only taking $20,000 from their IRA. Same total amount of money as you, but the provisional income calculation is different. Why? Because only half the Social Security benefit counts. So half of 40 is 20, plus all the IRA counts. That's another 20. That's 40 in total. Run that through the thresholds. Only 10% net effect of their Social Security is going to get taxed. 90% is going to come in tax-free. What should you take away from this? Provisional income matters, right? Understanding what comprises provisional income and how to keep it as low as possible matters. This ways to affect it. When do you apply for your Social Security benefit? Do you take it early? Do you take it at full retirement age? Do you take it late? That can affect provisional income. What about capital gains and RMDs coming in the door you may not need or may not want? Of course, those are going to affect your provisional income. The last thing you should note here, and it's important to take this away, is stop talking to your best friends and your neighbors about what their tax bills look like and then comparing it to what your situation looks like. Because as you can see here, you can live on the exact same amount of money as your neighbor or your best friend or your brother-in-law and pay a very different tax bill. Because, and I would write this down, it is not how much income you live on in retirement that determines what your tax bill is. It's where your income comes from. Two people, same amount of income, very different result from a tax bill perspective. Now, all 3 of those can affect your modified adjusted gross income on your tax return. Your modified adjusted gross income is what determines how you pay premiums on your Medicare. Your Medicare, once you're old enough to receive it at age 65, is income adjusted. At $194,000 or less for a married couple, you're going to pay base rates for Medicare Part B and D. Anything above that, and they're going to start increasing your premiums as your income goes up. A couple things to note here. Number one, there's a 2-year lag. And so your 2023 tax return is what's going to determine your 2025 Medicare premiums. Okay. Note number two, a lot of you may be looking at this going, you know what, Brad, I am never going to, my family doesn't need more than $194,000 of income to live on in retirement. I don't have to worry about this portion. And so I'm just going to kind of tune out because I'm never going to pay more than base rates for Medicare. But hang tight. Just because you don't need $194,000 of income to spend for your lifestyle in retirement doesn't mean $194,000 won't hit your tax return, because you may have income coming in the door that you don't even need and you don't even want and you can't control through things like RMDs, through things like capital gains. And one thing we haven't even discussed, and I see it a lot, is an inheritance. Because your parents pass away, they leave you money, that's a taxable event to you. It can also affect your income on your 1040. So what I want to talk about now before we get to the concepts is effective marginal rates. And this will lead us really well into the 3 concepts I'm going to leave you to take home to start taking action on some of this education and hopefully minimize your tax bill. So marginal rates we defined earlier. Effective rates are different. Marginal rates, last dollar of income fell into what bucket? That's my marginal rate. Effective rates are how much of your last dollar do you actually lose to Uncle Sam. Quick review here. Remember, this is what the set of stairs looks like for these 7 bucket system, 10, 12, 22, 24, right? We looked at this earlier. So it stands to reason that as the income comes in the door throughout the year, I just kind of walk the set of stairs, right? Pay 0 for a little bit because I got deductions, then 10, then 12, then 22. You guys get the point. Unfortunately, it doesn't always work that way. A lot of times, the effective rate you're paying while you're walking the set of stairs isn't the same number that's on the stair. In other words, you can be in the 10% bucket paying something different than 10%. You could be in the 24% bucket paying something different than 24%. Well, Brad, how does that happen? And how do I know if it's happening to me? Great question. Let's go through a case study. So we've got married couple here, John and Jane. This is this is a real scenario that I scrubbed the names and rounded off some of these numbers. But this is married couple. One spouse is 73. The other one is 69 years old. Their situation is about $65,000 in Social Security, $17,000 of long-term capital gains, and $48,000 required minimum distribution. Now, that's the simple version of their taxes, but these are kind of the big rocks that comprised their income. Social Security, which is what they were living on, by the way. This particular couple didn't need any money beyond their Social Security, but because of their allocation in their after-tax accounts, they did have capital gains, even though they didn't sell anything. And because of their age, they did get these RMDs, even though they didn't need them from a cash flow perspective. This is their set of stairs. The yellow is their marginal rates. We've been looking at this entire time. The gray is the effective rate that they paid while they walked this set of stairs. Now, that probably looks a little crazy to you. In fact, something probably stands out quite significantly. When you're looking at that and you're like, gosh, Brad, they're floating above the set of stairs almost the entire time. They're never paying the actual marginal rate. They're paying higher than the marginal rate. And on top of that, for a period of time, it was really egregious, 49.95%. Now, the majority of that 49.95% effective rate fell while they were in the 12% marginal tax bracket. So how do you be in a 12% tax bracket and pay 49.95% effectively? Well, let me show you. If you take $1,000 out of an IRA and you're in the 12% bracket, intuitively, you should have to pay $120 in taxes or 12%. But in this particular case, what happened is you take the $1,000 out, you do pay that 12% or $120. But you also have 2 other tax bills that you have to pay, because that $1,000 IRA distribution had a cascading effect. It changed your provisional income, which means some of your Social Security is going to move from one threshold to a different threshold. In other words, it goes from not taxable to taxable. So that's going to cause $850 of that Social Security to become taxable that wasn't before. So the cascading effect is I got a second tax bill. That tax bill is $102. Those two cascade into a third problem. The $1,000 IRA, the additional $850 of Social Security, takes a total of $1,000 plus $850, $1,850 of their capital gains that was in the 0% bucket, 3-bucket system, and moved it into the 15% bucket. That caused a third tax bill. That bill was $277.50 for a effective rate, or total bill, if you will, of $499.50. That is how you get a almost 50% effective rate when you're in a 12% marginal tax bracket. Now, what you should take from this before I get to the checkpoint is very simple. When you're in retirement, you've got money coming in from all these different sources. If you're a married couple, there could be 2 different Social Security payments. There could be a pension. There could maybe even be a second pension. I've seen some families have like 4 different pensions because of old jobs and things like that, 4 or 5. You could be taking distributions from after-tax accounts, IRA distributions. You could be taking Roth distributions. You could have rental income coming in the door. There's all kinds of different things, but it's kind of flowing in from all these different directions. And when it hits your 1040, it almost sets off a time bomb. Because although independent, those items don't look that bad from a tax perspective. When they hit your 1040, sometimes we can cause this cascading effect of different tax bills and make your effective rates peak for periods of time when we don't want to. So what do you do about it? Well, checkpoint. Have you performed any current or future RMD planning? If you're just letting RMDs happen to you, in other words, you're not yet 73 and you have done nothing to prepare your pre-tax accounts for RMDs, or you are of RMD age and you're not doing anything proactive to minimize them in the future, then I wouldn't check that box. Have you efficiently allocated your investments to lower turnover, capital gains, and unforeseen expenses to gain control over the taxes that your after-tax accounts spit off? Have you planned to maximize your Social Security in retirement? In other words, filing ages. Are you going to take it early, at full retirement age, or late? And then how's that going to affect your provisional income? Have you performed efficient income planning to maximize your retirement paycheck, making sure that you're pulling income from the right buckets to get the most efficient or smallest tax bill you possibly can year over year, and then perform any tax planning to avoid excess taxes? Now, 3 concepts to take home. These are all for this immediate impact that we talked about before, and it's essentially going to go through these 3 concepts: diversifying among account types, using tax-deferred products only where appropriate, blending withdrawals from different buckets to get to your income paycheck, and then considering which assets should be held in which account type. So here they are: 3 types of money to defer or not to defer, and the widow's tax. 3 types of money. When it comes to taxes, there are only 3 types of money. And so here's what you need to know or understand: that if you buy ABC company stock, hypothetical stock on the left-hand side of the screen, that where you buy it is going to determine what your tax bill is. In the pre-tax bucket on the left, it's pre-tax money that goes in, but it's fully taxable on the way out. Not only what you deposited, but all the growth as well, and all of it at 7-bucket full retail rates. The after-tax and tax-free bucket are different in that it's not pre-tax money you use to buy ABC company stock. It's after-tax money. Okay? It's checking account money. They're different in how you pay taxes on the growth. So if you deposit $1,000, you've already paid taxes on the $1,000. If ABC company stock goes up in value to $2,000, in the middle bucket, you have to pay capital gains taxes on that $1,000 of growth. In the Roth IRA, you don't have to pay any taxes on the growth. Of course, assuming with a Roth IRA, there's the caveat that you have to have that account for 5 years. Okay. Now, ABC company stock can also go down in value. So it's important to understand from a tax perspective, if you lose money in your investments, it doesn't matter where you invested it from a tax perspective, pre, post, or free, you're going to lose money. Except in the middle bucket, you have a little bit of a reprieve. You can write those losses off, or you can take advantage of something called tax loss harvesting, or you can use those losses you took in that investment to offset gains you have in a different investment. In other words, if you're going to lose money, it's the most efficient bucket to do it. But understand, when it comes to taxes and your investments, there's only 3 places you can put it: your pre-tax buckets, your after-tax buckets, or your tax-free buckets. Also important to note, if you don't spend all this money while you're alive and it goes to the next generation, that at your death, The pre-tax bucket, which was fully taxable to you while you were alive, remains fully taxable to the next generation. Now, that's a problem for a lot of families because typically if mom and dad pass away 85, 90, 95 years old, their kids are in their 50s and 60s with higher tax bills than mom and dad. And so mom and dad chose to defer, and not pay the bill on their 401ks and IRAs beyond the RMDs. They give that money to the kids. The kids have to pay the tax bill over a 10-year period. And unfortunately, they end up losing a lot more to the IRS had they just paid the bill on their own while they were alive. The middle bucket, you get a step up in basis. Here's what that means. If you bought ABC company stock for $1,000 and today it's worth $1 million, extreme example, you have $999,000 of gains. Should you sell that position while you're alive, you got to pay the taxes, the associated capital gains tax on $999,000 of gains. If you die having never sold it, your beneficiary gets to inherit it as if they paid for that stock, what it's worth today. My example, $1 million. So they get to act as if they paid $1 million for that $1 million stock. So if they sell it, how much gain do they have? Zero. So what's their tax bill? Zero. It's called a step up in basis. It's a really cool thing. Last but not least, Roth IRA, tax-free growth for you while you're alive, assuming that 5-year window has been satisfied, also tax-free to the next generation. Last but not least in this concept, and this is very, very important. You want the least amount of risk in your 401k and the most amount of risk in your Roth IRA. In other words, you need to audit your portfolio. We all have portfolios where some of our investments are less risky and some are more risky. The less risky investments need to be in your 401k because that's where the highest tax bill is. The more risky investments need to be in your Roth IRA because if you're taking more risk, the only reason you're doing it is because you're trying to get higher returns. Otherwise, why would you do it? Well, if I'm trying to get higher returns and taking more risk, I want that in the bucket where if I'm right and that risk pays off, I don't owe taxes on these high returning assets. I don't want to hit home runs in my 401k where I have to pay ordinary income taxes and all the growth. If you've never done a portfolio audit, not investment audit, a portfolio tax audit, it's very likely that you're being very tax inefficient with your risk. In other words, all this risk you're taking for the sole fact of you're trying to grow your money, you're going to lose more of that growth to the IRS than you probably should or could. Very important that you do that. The second one is to defer or not to defer. I'm going to go through this kind of quick. It's a simple concept, but we get the question all the time. Do you leave your money in your IRAs or do you begin to pull it out? Well, it's important to know you can pull it out. You don't have to wait till you need to spend the money. You can pull it out anytime you want. I always use a mortgage as an example. If you have a mortgage, you can wait 30 years to pay it off and just make your minimum payments, right? Or you can wait till you're 73 and let the IRS force your hand to start making your minimum IRA payments. Or you can just start pulling it out whenever you want. Doesn't mean you have to spend it. You can do whatever you want with it. So should you? You can take IRA money and convert it to Roth money. So it goes from pre-tax taxable to after-tax tax-free. You can do as much as you want whenever you want. The question is it a good deal or is it not a good deal? Well, in our example, we've got a $100,000 IRA, a 25% tax bill. So should we convert that to Roth? We have 75 grand. Was it a good deal or a bad deal? Well, let's fast forward 10 years. Had we left the IRA alone, assuming they're invested exactly the same, the IRA and the Roth, and they both double in value, at the end of 10 years, the IRA is going to go from 100 to 200. The Roth doubles in value, goes from 75 to 150. This is where my industry champions the superior cause of tax deferral. And they go, look, Brad, 10 years ago, the difference in value would have been 25 grand. Today, the difference in value is 50 grand because the entire 100 grand got to work for us. If we paid the bill 10 years ago, only 75 cents on the dollar got to work for us because we had to pay the bill. The problem is it's not about how much money you have. It's how much of your money do you get to keep. And so now it's time to pay the taxes. Now it's time to use the money. So we got to take the tax bill out of the IRA and we got to take the tax bill out of the Roth IRA. Assuming tax rates do not change. They were 25% 10 years ago. They're 25% today. Well, guess what? In both scenarios, after you pay the tax bill, you've got $150,000 because there is no tax bill on the Roth. So which one's better? Well, the simple answer is neither one of them. An IRA, and it's very important you all note this, an IRA is simply a bet you're making with your own money relative to taxes. And that bet is, I think my tax rates are going to be less in the future, so I'm not going to pay the bill today. A Roth IRA is the opposite bet. I think my tax rates are going to be higher in the future, so I'm going to pay the bill today. not going to wait until my adjustable rate mortgage adjusts up on me. I'm going to prepay my mortgage as much as I can before I think these rising rates are going to hit me. So IRA, you're making a bet your taxes are going down. Roth IRA, you're making a bet your taxes are going up. It really is that simple. So how much should you have in each bucket? Well, first and foremost, you should have both. So number one, if you have never opened a Roth IRA, you've never converted any money to a Roth IRA, you've never contributed to a Roth IRA, I would contend you need to at least explore that option. Or if you're like the person at the beginning of the workshop that has 80% of your money in pre-tax accounts, maybe it makes sense to start diversifying that a little bit more from a tax perspective so that 80% of your money is not making the bet that your tax rates go down in the future. Last but not least, the concept of widow's tax. Now, if you were not married, hang with me because you know somebody who is, and this is vitally important, and you can share this education with them. If you were married, you have a deduction or exemption you will not always have. In other words, what are the odds that you and your spouse die on the exact same day? Not good, right? The surviving spouse is going to be a widow, and that's going to have a dramatic impact on the taxes that your family pays. Let me give you the example. Married couple, $8,000 of income coming in the door or $96,000 a year. That's their lifestyle, $8,000 a month. They took the standard deduction, total tax bill of the Fed, $71.85. That's an average rate of 7.9%. Now, spouse A passes away. Spouse B wants to maintain lifestyle, live on the same $8,000 a month. Gravy, same amount of income, no problem. The problem is the tax bill associated is much different because they're not married. They don't get to file a joint return. So the same $8,000 a month comes in the door, same $96,000 a year, but the average tax rate goes from 7.9% to 13.8%. That is a 75% increase in the effective rate that your family is going to pay on the same amount of income because your spouse passed away. I'm going to ask the question one more time. What do you think the odds are this happens to you? What do you think the odds are that you and your spouse die on the same day? Not good, which means the odds this is going to happen to you is really high. And so how you file taxes relative to being married or single is also a part of your overall tax planning and needs to be taken into account as you're making your decisions. Final checkpoint. Have you performed a plan to efficiently allocate your money to the 3 tax buckets? In other words, have you audited your portfolio from a tax perspective? If you've never had anybody audit your portfolio, let us help you and at least get the audit done and show you where you're taking your risk and if it's efficient or not. Do you have an IRA exit strategy? And is your plan set up for the unexpected death of a spouse? Now, there's about 10 different checkpoints throughout today's webinar. As doers, right? If you're a drifter that somehow found your way in here, this is not for you. But if you are a doer and you're the person that kind of lets your lifestyle lead your life and you have not checked every one of these checkpoint boxes, we will help you get started. As one of the resources, the complimentary resources of attending today's educational workshop, you have the ability to take advantage of what we call a tax clarity visit. We will help you get started. As I see it, there's no reason not to take advantage of this because it's complimentary. There's no strings attached. What we're going to do is begin by going through all those checkpoint items with you and help you get started. In the bottom left-hand side of your screen, this popped up earlier in today's workshop. You can click on that little link below and that little kind of purplish blue button. That's going to take you to Scott's calendar and allow you to schedule time with Scott to continue answering questions. We're going to begin by giving you some tax guides. We are going to give you a personalized tax report and build you a tax map. If that popped up in the middle of your screen, you can hit the X to show it on the side of your screen again. But the personalized tax report and the customized tax map are the opportunity to help you figure out, are your taxes on sale? Should you be doing something differently? What does that look like for your family? And once we give you these reports, as an example report in the handouts and these tax maps, you have a really good starting point to answer a lot of these checkpoint questions and take a lot of this education and apply it to your family's situation. Thanks so much for attending today's workshop. I enjoyed having all of you on here. Thanks for keeping Scott super busy in the Q&A box. We appreciate that as well. Any and all questions are welcome. Have a wonderful rest of your day and make sure you take advantage of that tax clarity visit. We look forward to chatting with more of you on a one-on-one basis in the next coming couple of days. Have a wonderful day. We'll talk to you soon.